Reminiscences of a Stock Operator, by Edwin Lefevre. Introduction. Imagine a time before smartphones, before the internet, before you could pull up a stock chart with a single tap. Imagine a bustling, smoke-filled room in the late 1800s. A huge chalkboard dominates one wall, and a 14-year-old boy is scrambling to keep up, chalking numbers as they're shouted from a clicking, chattering machine in the corner, the stock ticker. This boy isn't just writing numbers. He's seeing patterns. He's seeing a language that no one else seems to understand. To everyone else, the ticker is just noise. To him, it's a story unfolding in real time. He notices that before a stock makes a big move, up or down, it behaves in a certain way. It whispers its intentions. He starts keeping a little notebook, jotting down his predictions. Not with imaginary money, but just to see if he's right. More often than not, he is. One day, an older office boy comes to him with a hot tip. A stock is sure to go up, but this young man doesn't care about the tip. He checks his notebook. His own observations confirm the pattern. He pools his meager savings with his friend, a total of $5, and places a bet. A few days later, his share of the profit is $3.12. It's not much. But for that young boy, it was everything. He had just proven that his secret language was real. That boy's name was Jesse Livermore, though in the book we're about to explore, he goes by the pseudonym Lawrence Livingston. And that small trade was the first step in a journey that would see him make and lose fortunes of millions, become a Wall Street legend known as the Boy Plunger, and ultimately, reveal the timeless secrets of the market. Today, we are diving into one of the most revered books ever written about trading, Reminiscences of a Stock Operator. First published over a century ago as a series of articles by the journalist Edwin Lefevre, this book is not a how-to guide with charts and formulas. It's something far more valuable. It's a look into the mind of a master. It's been called the investment Bible by titans of finance, from the founder of Fidelity funds to legendary traders of our own time. And my promise to you is this: by the end of our journey today, you will understand the fundamental psychology that drives all markets, from stocks to crypto to anything that will ever be traded in the future. You will learn the difference between gambling and intelligent speculation, and you'll discover the most dangerous enemy a trader ever has to face. Hint: it's not the market. It's the person you see in the mirror every single day. Book summary. Our story begins not on the grand floor of the New York Stock Exchange, but in the shadowy back rooms of what were called bucket shops. Now, you have to understand, these weren't legitimate brokerage houses. They were little more than betting parlors. You weren't actually buying a piece of a company, you were betting against the house on which way a stock price would move. The odds were stacked against you, and they were designed to wipe out small-time gamblers. But for young Livingston, the bucket shop was a perfect laboratory. With his photographic memory for numbers and his ability to read the tape, that little ribbon of paper printing out the stock prices, he wasn't gambling. He was playing a system. He explained it simply: prices, I saw, were always changing. It was all I had to be interested in. I simply saw that they changed. He wasn't thinking about the company, the economy, or the news. He was focused on one thing: the behavior of the price itself. He realized that whatever happens in the stock market today has happened before and will happen again. History was his guide. He started small, with just a few dollars, and his system worked. He'd see a pattern, place his bet, and get out with a small, quick profit. Soon, he was making more money during his lunch hour than he was from his full-time job as a board boy. At the age of 15, he had made his first $1,000. He brought it home in cash and laid it on the table in front of his mother. She was terrified. She thought it was more money than any boy should have and begged him to put it in a savings bank, away from temptation. But for Livingston, the money wasn't the point. He said, "I didn't think of anything except that I could keep on proving my figuring was right. That's all the fun there is? Being right by using your head." If he was right with 10 shares, he'd be 10 times more right with 100. The money was just a way of keeping score. Of course, the bucket shops weren't too happy about a kid who kept winning. They were in the business of taking money, not giving it away. One by one, they started refusing his business. They'd see him walk in and just shake their heads. "Nothing doing," they'd say. He had to start using fake names, even wearing disguises, but his unique trading style always gave him away. They called him the Kid Plunger, and soon, every bucket shop in his hometown had barred him for life. He was a victim of his own success. The very system that made him a winner had made it impossible for him to play. So, at the age of 21, with a few $1,000s in his pocket, he knew he had to go to the major leagues, New York City, the heart of Wall Street. He was finally going to trade in a real brokerage house, where he could buy and sell as much as he wanted. He thought his system was unbeatable. He was about to learn a very painful lesson. In his first 6 months in New York, he lost everything. He went completely broke. The system that had worked flawlessly in the bucket shops was a total failure on the New York Stock Exchange. Why? Because the game was entirely different. In a bucket shop, when you placed a bet, the price was fixed instantly. You knew your exact entry and exit point. It was like lightning. But on the real exchange, there was a delay. By the time his order to buy or sell traveled from the broker's office to the floor of the exchange and was executed, the price had often moved. The ticker tape, which had been his trusted guide, was now telling him ancient history. He was always a step behind the real market. He said, "I lost in New York because the game was altogether different. I was playing it ignorantly." This is a profound moment in his journey. The boy genius, the prodigy who could read the market's secret language, was humbled. He learned that raw talent isn't enough. You have to understand the rules of the specific game you're playing. Broke and humbled, but not defeated, he knew there was only one way to get back on his feet. He had to return to the only game he knew he could beat. He went to his broker, a man named Fullerton, and asked for a $500 loan. Not to trade in New York, but to go back to the bucket shops in another city and build a new stake. Fullerton, seeing the conviction in this young man's eyes, gave him the money. Livingston traveled to St. Louis, where he found new bucket shops that hadn't yet heard of the boy plunger. Within 2 days, he had turned that $500 into nearly $3,000. But just as before, his success made him a target. The owner of the shop called him into his office. He pointed to the crowd of customers outside. "See them?" he said. 300 suckers. They feed me and my family. Then you come in, and in 2 days you take more than I get out of the 300 in 2 weeks. That ain't business, kid. Not for me." He was kicked out again. He returned to New York with a small stake and a new resolve. He had to unlearn his old habits and master this new, more complex game. And this is where his real education began. The biggest turning point came from an old man in his broker's office, a quiet fellow they called Turkey because of the way he strutted around. While other traders were frantically jumping in and out of the market, chasing tips and rumors, this old man, Mr. Partridge, was calm. When eager young traders would ask him for advice, telling him about a hot stock and asking if they should take their profits, he would always smile and say the same thing, "You know, it's a bull market." At first, Livingston thought the old man was just senile. What kind of advice was that? But one day, he watched a young trader named Elmer rush up to Partridge. Elmer had just sold all his stock, taking a nice profit, and he urged the old man to do the same. "You'd better slip them that stock of yours and buy it back on the reaction," Elmer insisted. Old Partridge looked at him with great distress and said, "My dear boy, if I sold that stock now, I'd lose my position, and then where would I be?" Lose his position? What did that mean? The phrase stuck in Livingston's mind. He began to think about his own trading. He'd often correctly predict a major market trend, but he'd make only a fraction of the money he should have. Why? Because he was too eager to take small profits. He'd buy a stock, it would go up a few points, and he'd sell, patting himself on the back for being smart and conservative. But then he'd watch in agony as the stock continued to soar another 20, 30, or 50 points without him. He finally understood what Old Man Partridge meant. The old man wasn't interested in the small, day-to-day fluctuations. He was focused on the big swing, the main movement of the entire market. He knew that in a bull market, the real money wasn't made by jumping in and out, but by buying right and sitting tight. Selling out for a small profit meant losing his position in the grand march of the market. Livingston said this was the moment his education truly took a leap forward. He reflected, "It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight." Men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn. But it is only after a stock operator has firmly grasped this that he can make big money. This was the transition from being a gambler to being a true speculator. A gambler bets on fluctuations. A speculator anticipates probabilities. He stopped looking at individual stocks and started studying the entire market, the basic conditions of the economy. He was no longer just reading the tape, he was reading the world. His first major test of this new philosophy came in 1906. Studying the global economy, he saw signs of trouble everywhere. Wealth had been destroyed in wars, natural disasters like the San Francisco earthquake had strained resources, and money was becoming tight. He concluded that a major crash was inevitable. He was bearish on the entire market. So, he started selling short, betting on a decline. The market went down a little, just as he predicted. But then, it rallied. His paper profits vanished and turned into losses. He covered his positions, losing a chunk of his capital. He waited, sold short again. The same thing happened. A small dip, followed by a punishing rally. Soon, he was completely wiped out. He was right about the crash. It was coming. But he was broke. What went wrong? He said it himself, "So much for sprinting too soon. I was too eager to prove to myself that I had seen real dollars and not a mirage. I saw, and knew that I saw. Thinking about the reward for my excellent sight kept me from considering the distance to the dollar heap. I should have walked and not sprinted." This is a lesson that costs traders millions, even today. Being right is not enough. You have to be right at the right time. He had correctly diagnosed the disease, but he had started performing the surgery months too early. The patient, the market, was still strong enough to fight back. But Livingston was a student of his mistakes. He didn't give up. He waited. He watched. He knew the crash was still coming, closer every day. The final signal he was waiting for came in an unexpected form, a newspaper advertisement. Two of the country's biggest railroads announced they were issuing new stock, but they were allowing stockholders to pay for it in installments. This had never been done before. To Livingston, it was a signed confession from the most powerful bankers in the country. It meant they knew money was so scarce that even their own wealthy stockholders couldn't afford to buy the stock outright. The financial engine of the country was running out of fuel. This time, he didn't sprint. He began his campaign methodically. He sold stocks short, and this time, the market did not rally. It began to slide. His paper profits grew. Other traders told him he was crazy, that the big interests would squeeze the bears. But Livingston wasn't trading on rumors anymore. He said, "I felt for the first time in my life that I had allies, the strongest and truest in the world, underlying conditions." The market continued to crumble, culminating in the Great Panic of 1907. On one particular day, October 24th, hell broke loose. There was no money to be had. Brokers couldn't borrow, which meant they were forced to sell their clients' stocks at any price. The market went into a freefall. There were no bids for some of the biggest stocks in the country. The entire system was on the verge of collapse. Livingston, heavily short, saw his paper profits swell beyond his wildest dreams. He was in a position to push the market over the edge, to create a crash so devastating the stock exchange might have to close. It was at this moment that a message came to him, a message from the most powerful man in finance, the great J.P. Morgan himself. The message was simple: we hope he will not sell any more stocks today. Appeal to his patriotism. Livingston had already come to the same conclusion. A total collapse would harm the country and ultimately himself. He wasn't just a trader anymore, he was a market force. So, in the midst of the panic, as others were desperately selling, he did the opposite. He began to buy. He covered all his short positions at the very bottom of the crash. That day, he made his first $1 million. He called it his day of days. It wasn't just about the money. It was the successful end of his first campaign based on a grand strategy. He had looked ahead, analyzed conditions, acted with patience, and won. He had finally graduated from being a tape reader to being a market master. You would think that after a victory like that, after finally cracking the code, he would never lose again. But the market has a way of teaching you that there are always more lessons to learn. And the next lesson would be the most expensive of his life. His downfall didn't come from a market crash or a bad trade. It came from a man. His name was Percy Thomas, another legendary speculator, known as the Cotton King. Thomas was a brilliant, charismatic man, a magnetic personality. Livingston admired him greatly. After Thomas suffered a major loss, he approached Livingston with a proposition, a partnership. Thomas had an incredible network for gathering information on the cotton market. He would provide the intelligence, and Livingston, with his trading genius, would execute the trades. Livingston refused. He told Thomas, "I play a lone hand by choice. I get my pleasure out of matching my brains against the brains of other traders." He knew he couldn't trade on another man's information. But Thomas was persistent. They became friends. They talked for hours about the cotton market. Thomas was incredibly bullish, armed with facts, figures, and an unshakable conviction. Livingston, who had been bearish, started to doubt himself. He couldn't disprove Thomas's arguments. He explained, "I cannot say that I got all mixed up, exactly, but I lost my poise. I ceased to do my own thinking. I came to read conditions as he himself read them." Against his own judgment, against the whispers of the tape that had guided him for years, Livingston abandoned his own convictions. He covered his short positions in cotton and went long. He bought, and then he bought more. The market wasn't acting right. It wasn't behaving the way it should if Thomas was correct. But instead of cutting his losses, he did the one thing a speculator must never do: he tried to support the market. He kept buying more cotton, trying to keep the price from falling. It was, in his own words, a super sucker play. At the same time, he had a large, profitable position in wheat. Feeling nervous about being overextended, he decided to lighten his load. In a moment of spectacular folly, he made a classic, fatal mistake. He sold the position that was showing him a profit, the wheat, and kept the one that was showing him a loss, the cotton. He said, "Of all speculative blunders there are few greater than trying to average a losing game. Always sell what shows you a loss and keep what shows you a profit." The wheat, which he sold, went on to soar, a trade that would have made him millions. The cotton, which he kept, collapsed. He lost almost everything. The $1 million he had made in the 1907 panic, and more, was gone. He was beaten not by the market, but by his own humanity. He had allowed himself to be swayed by a powerful personality, and he had violated his most fundamental rules. He learned that another dangerous enemy to a trader is his susceptibility to the urgings of a magnetic personality when plausibly expressed by a brilliant mind. The years that followed were long and lean. He was over $1 million in debt. He was broke, discouraged, and for the first time in his life, he felt that his confidence was shaken. He realized he could never trade effectively with the weight of his debts hanging over him. So, he made a difficult decision. In 1915, he declared bankruptcy. It was humiliating, but it was necessary. It freed his mind. Now, he needed a new stake. His old broker, the same Dan Williamson who had once used him as a smokescreen, offered him a sliver of a chance, a credit to trade just 500 shares. It was a tiny fraction of what he was used to, but it was a start. For 6 long weeks, Livingston did nothing. Broke and desperate to trade, he went to a broker's office every single day, but he didn't place a single order. He just watched the tape. He was bullish on a stock called Bethlehem Steel, a company booming from the war in Europe. He was certain it was going to soar. But he knew this first trade had to be a winner. He couldn't afford to be wrong. He forced himself to wait for the perfect psychological moment. He decided he would not buy until the stock crossed the critical price of $100 a share. He watched it climb from the 80s into the 90s. Every point it went up was money he wasn't making. The temptation was agonizing. He said, "Those 6 weeks of waiting for the right moment were the most strenuous and wearing 6 weeks I ever put in." When the stock hit 98, he couldn't wait any longer. He felt it in his bones. The tape was screaming at him. He rushed to his broker's office and bought his 500 shares. The very next day, the stock was trading at 145. He had his stake back. Patience and discipline had won. He had waited for the market to confirm his judgment, and it had paid off. From that moment, he was back in the game. Over the next 2 years, trading with his renewed confidence and hard-won wisdom, he made millions. The first thing he did? He paid back every single creditor from his bankruptcy, in full, with interest. He even tracked down the one small creditor who had harassed him the most and made him wait until last, just to teach him a lesson in consideration. With his debts cleared and his fortune restored, he did something he had never done before. He took a significant portion of his winnings and put it into annuities and trust funds for his family, structured in such a way that he himself could never touch it. He said he did it to protect his family from me. He knew, better than anyone, that the game was a dangerous one, and that no victory was ever final. Livingston's story is a cycle of spectacular success and crushing failure, of learning and forgetting and learning again. He teaches us that the market is a masterful, if sometimes brutal, teacher. It doesn't reward hope or punish fear. It rewards observation, patience, and the courage to act on your judgment while having the discipline to admit when you are wrong. He reminds us that the stock market is never obvious. It is designed to fool most of the people, most of the time. The public wants to be told what to do. They crave tips. But Livingston warns that tips are the most pernicious enemy of a speculator. The real information is not in the whispers of so-called insiders, but in the unemotional, unbiased language of the tape itself. A stock is going up because there is more buying than selling. A stock is going down because there is more selling than buying. That is all you need to know, and all the tape will ever tell you. Ultimately, his philosophy boils down to a handful of timeless truths. The big money is not in the day-to-day fluctuations, but in the great market trends. To be right and to sit tight are two different things, and it is the latter that is the most difficult. You must never argue with the tape. You must not hope when you ought to fear, and you must not fear when you ought to hope. And above all, you must know yourself, because in the game of speculation, the man who is a fool for hope, who is paralyzed by fear, who is blinded by greed, or who is swayed by another man's charisma, is a man who is destined to lose, no matter how much he knows. As Livingston himself concludes, a man may beat a stock or a group at a certain time, but no man living can beat the stock market. His life was a testament to that truth. He won fortunes when he rode the great waves of the market, and he lost them when he tried to command the ocean. Commentary. So, what do we take away from a story written 100 years ago, about a world of tickers and chalkboards? It's tempting to think that our modern world of algorithms and instant information has changed the game entirely. But if you listen closely to Livingston's story, you realize that nothing fundamental has changed at all. The technology has evolved, but human nature has not. The lessons in Reminiscences of a Stock Operator are not really about stocks. They are about psychology, discipline, and the eternal battle between reason and emotion. This book has endured because it speaks to a fundamental human struggle. We all want to believe there's a shortcut, a secret piece of information that will give us an edge. We are all susceptible to the siren song of hope and the paralyzing grip of fear. Livingston's life is a powerful reminder that there are no shortcuts. Success in any high-stakes endeavor comes from study, patience, and brutal self-honesty. One of the most powerful ideas in the book is the concept of sitting tight. In our hyper-reactive world, where we are encouraged to constantly check, update, and react, the idea of doing nothing is almost revolutionary. Livingston teaches us that once you've done your homework and made a decision based on sound reasoning, often the most profitable action is inaction. It's about having the conviction to let your strategy play out, to resist the emotional urge to fiddle with it at the first sign of trouble. This is a lesson that applies far beyond the stock market. It applies to building a business, to pursuing a long-term career goal, or to any venture that requires a long-term vision. The other profound lesson is about the danger of losing yourself. Livingston's greatest loss didn't come from a bad market call. It came when he stopped trusting his own judgment and started playing another man's game. He allowed the charisma and conviction of Percy Thomas to override his own internal compass. How many times in our own lives do we do this? We listen to the convincing arguments of others, friends, family, experts, and we abandon our own intuition, only to regret it later. Livingston's costly mistake is a timeless warning to cultivate and trust your own independent thinking. So, how can we apply this wisdom today? Here are a few simple actions inspired by the book. First, become a true student of whatever game you choose to play. Livingston didn't just dabble, he dedicated his life to understanding the market. Whether your interest is in investing, starting a business, or mastering a craft, commit to deep study. Don't just look for tips and shortcuts. Read the history, understand the fundamentals, and learn from the mistakes of those who came before you. Second, develop your own set of rules and have the discipline to stick to them. Livingston's system wasn't complicated. He bought on a rising market, sold on a falling one. He cut his losses quickly and let his profits run. The key was not the complexity of the rules, but his unwavering adherence to them. Take some time to write down your own principles for making important decisions. What are your non-negotiables? What are the mistakes you are prone to making? Having a written set of rules can be a powerful anchor in moments of emotional turmoil. And third, practice emotional detachment. This is perhaps the hardest lesson of all. Livingston learned to view his losses not as personal failures, but as tuition fees for his education. He never argued with the market, he accepted its verdict and moved on. The next time you face a setback, whether it's a financial loss or a personal disappointment, try to step back and analyze it with the cold detachment of a scientist. What can this failure teach you? How can you capitalize on this mistake to make your next move smarter? That was a summary of Reminiscences of a Stock Operator by Edwin Lefevre. We've explored the highlights today, the incredible highs and the devastating lows of a trading legend. But a summary, no matter how detailed, can only ever be a map. The real treasure is found when you make the journey yourself. The true power of this book is in the stories, the details, and the quiet moments of reflection that can only come from reading it. This summary is your guide to decide if this journey is one you want to take. If anything we've talked about today has sparked your curiosity or resonated with a part of your own ambition, then I encourage you to pick up a copy. Reading it isn't just about learning the secrets of the market, it's an experience that can fundamentally change how you think about risk, discipline, and yourself. The link to the book is in the description below. Also, if you've found this journey into a classic valuable, please show your support by liking this summary and subscribing to the channel. That way, you won't miss our next deep dive into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.